Let's stay on this inflation report here. Let's bring in Tendayi Kapfidze, Chief Economist at U.S. Bank. Tendayi, you just heard President Biden's statement here on inflation. What impact do you think an inflation report that it's close to 8% on the headline, what impact is that having on U.S. households?
So it makes it really difficult for people to kind of manage their core expenses, right? I think the really standout thing here in this inflation report and likely inflation reports for the next couple of months is that the items that are increasing the most are items that, for most people you can't avoid, right? So you can't avoid paying your rent. You can't avoid, driving your car to work. A lot of the inflation that we were seeing last year wasn't necessarily touching every part of the population. So, for example, if you didn't buy a car last year, you weren't really participating in all that auto inflation that we're seeing. So the type of inflation that we're seeing now, which touches products and goods that a lot more people use, is much more problematic for households than the type of inflation we were seeing this time last year.
Well, and Tendayi, in addition to that, and this is a really good point that you're making, President Biden calling this Putin's price hike is a little disingenuous because it didn't happen last month. It's mostly happened this month. So that suggests that even if there is some sort of resolution of this conflict and energy prices come down to some degree, there's still going to be, what does the inflation picture look like, even if that happens?
Yeah, I think if you were to go to, before this Russia crisis evolved, most inflation analysis was still on the expectation that we're going to start a deceleration in inflation, probably starting in the second quarter sometime. And that was because of the base effects from 2021. The Russia problem and the invasion in Ukraine and the subsequent impacts on commodity prices really throws, a spanner into that kind of assessment. And another secondary effect of that invasion is that we were expecting there to be improvements in supply chains, probably starting, later this year. That also puts into question some of the supply chain improvement that was supposed to lower some of this goods inflation. So, looking forward, there's definitely going to be an impact, from this invasion. Probably not so much in the February numbers, though.
Tendayi, do you think Fed rate hikes, which are likely to start next week with a 25 basis point increase, will they have any effect on what we're seeing right now with rising gas prices, you name it?
I don't know that they'll have an effect on gas prices, right, given that a lot of the impetus on the oil price is external and doesn't really relate to the Fed's actions. The thing with Fed rate hikes, right, oftentimes people are like, oh, the Fed is going to hike rates, and then you're going to see low inflation to fight inflation. There's a transmission mechanism there, right? The Fed, by hiking rates, raises the cost of capital. Raising the cost of capital reduces business investment. Reducing business investments reduces demand for labor. Reducing demand for labor reduces wages. Reducing wages reduces, consumer spending, and therefore eventually that reduces demand, and that eventually leads to lower inflation. So there's a transmission mechanism here from Fed rate hikes to low inflation. That transition mechanism is not necessarily a positive one, right? It really essentially is to slow inflation by lowering demand. You have to lower consumer demand, which means you have to lower wages and jobs.
Well, and effectively right now, some people are taking a pay cut because of inflation, right? At a time when on paper, maybe they're getting an increase, but because of inflation, they are not. So what you're describing, as you say, sounds like a pretty painful scenario. Just how painful will it be? In other words, are we going to see an economic slowdown as a result of this?
Yeah, so that's what Chairman Powell So Chairman Powell last week, in front of Congress said he was, trying to engineer a soft landing, right? This is the challenge that the Fed is facing, is that they want to go through this process and kind of ease demand and slow the economy, but they don't want to do it so much to an extent that you actually create a recession. So we'll see whether they can pull that off. It's going to be, a challenge, but I still think that's the base case, merely because the economy has so much room that it still has to recover from the coronavirus crisis, if you consider the level of jobs as well as, where GDP is versus where it was trending prior to the crisis.
So, Tendayi, I guess as much as you're able, what do the next few months look like from an economic perspective in the United States? Are we going to continue to see this rate of inflation or even hotter inflation? Because, of course, what the Fed is doing happens on a lag.
Yeah, so I think we're actually going to see some divergence in the inflation numbers, right? So we talk about the headline and we talk about core. When you look at headline, I think because of the oil price increases and other general commodity increases, and maybe even a little bit of some of these food price increases, means that the headline is probably going to continue to remain elevated, even if it doesn't accelerate from current levels. I think the core, which is what the Fed looks at in terms of monetary policy, is actually still going to decline as expected starting in the second quarter. It may not decline as fast as was previously expected. And we started to see some signs of that in this report, where we saw used car prices actually decline month over month, which is one of those categories that was a highlight of the inflation increases last year.
Tendayi Kapfidze, Chief Economist at U.S. Bank. Always good to see you. Have a great rest of the week.